Chapter 8, Current Liabilities. LO84, Explain accounting for other current liabilities. Additional other current liabilities companies might report include deferred revenues, sales tax payable, and the current portion of long-term debt. We're going to explore each of these in more detail now. Deferred revenues. We already know what deferred revenues are. Liability account used to record cash received in advance of the sale or service. So we record a deferred revenue when somebody gives us money and we owe them a service or we owe them inventory at a later date. So we record the receipt of the cash and we record a deferred revenue liability until which time we give up the service or the inventory later. Sales tax payable. As we know in North Carolina, when we buy things, we have to pay sales taxes. So we're going to discuss how to record sales taxes the company collects from customers. And lastly, current portion of long-term debt. When we have long-term liabilities that are due 5, 10, 15 years down the road, we have to reclassify a portion of that is due within the next year, and we'll discuss that as well. So this is an example of a revenue recognition policy. As you can see, United waits until the actual flight occurs to record the revenues. So, deferred revenues. When a company receives cash in advance, as we know, it debits cash and credits deferred revenue. So an example of this would be Apple selling an iTunes gift card to a customer for $100. We debit the cash as Apple receiving the $100 and credit deferred revenue for $100 because we know at some point down the road we're going to have to give up $100 worth of sales or services. So we're going to record the deferred revenue as the liability. Now, when the customer uses that gift card and purchases and downloads $15 worth of music, Apple needs to use up some of the deferred revenue. Not all of it has been used, but just a portion of it. So only do the portion that has been used up. So we no longer owe $15 worth of services. So we need to debit the deferred revenue for $15 and recognize sales revenue for $15 because the customer has now actually purchased and downloaded the music. The actual sales have occurred at this point in time, so we can get rid of our liability and record our sales. We already know this. This is not anything really new. We're just reviewing it as it relates to current liabilities. This is new stuff. Sales tax payable. As you know, like I said, in North Carolina, companies are required to collect sales tax when selling goods or services. And then those sales taxes are remitted back to state or local governments. Not all states collect sales tax, but in states that do, this is required. And since we do live in a state that collects sales tax, it is very important to understand this. The collection of cash from the customer creates a liability for the company. It is not a revenue. Hear me. When they collect the money, the sales tax, it is not a revenue to the company. It is a liability. That company owes North Carolina Department of Revenue money. They're simply holding it to be sent to them at a later date in time. So assume that you're at RDU and you buy lunch for $15 plus 10% sales tax. The airport restaurant would record the journal entry as shown. How much cash did the airport actually receive? Well, the airport received the $15 lunch plus 10% sales tax. They received a total of $16.50. So as the company, you need to record all the cash that you received. You received $16.50. How much of that $16.50 was actually revenue to you? only $15 was revenue. The other $1.50 is sales tax payable. $15 times 10% is $1.50. That is a liability. You must record it separately than your revenue. It is incorrect to combine them because that is not a revenue to the company. It is a liability because they have to record that and submit that back to the North Carolina Department of Revenue. You do not record it as a revenue and then an expense when it's paid. It goes in as a liability, and then when you pay it, the liability goes away. This is how you have to record it. Make sure you understand this. Current portion of long-term debt. Debt that will be paid within the next year. So if you have a 3-year note payable, 1 year of that is going to be due within the next year. You have to reclassify that. In this example, it's a 20-year mortgage. It's split and it's reported so that different amounts are due. Any amount that you're going to be paying within the next year is shown as a current liability. After that, everything else is shown as a long-term liability. You have to reclassify it and report it as current liabilities because they're becoming payable within the next year. They're becoming current amounts. They have to be paid. We want to make sure that the proper amounts are shown in current and long-term. And by reclassifying, that's how we show the proper amount as current and the proper amount as long-term. So here's Southwest Airlines. As you can see with Southwest, they had total borrowings of $3.38 million. Of that amount, $566 million will be due in the next year, and $2.82 million is due in more than a year. So the total amount borrowed is $3.3. $566 million is due within the next year, so it's reclassified in current liabilities as current maturities of long-term debt, and then the rest is shown as long-term. That's not saying that the whole thing is due, just this portion of the total amount is due within the next year.